là con của cái cô này, cô ấy là 15 cô đang chia ra cái giá trị tới của như tiền thì tôi nói là nếu mà trong trường hợp mà phụ trở nạn thì cô cứ gọi cho nước xong rồi cứ liên lạc với mẹ nó để mẹ nó cái trường hợp cho người ta ở dưới kia cái chỉ bị một oxy nó mất thì ca khác thì nó bị bệnh còn với lại nó đáp ứng bằng metro oxy ấy, thì nếu mà trong góc mà còn chứng thì ấy thì bạn sẽ bệnh và cùng với cháu thì bây giờ vì con nó cái chức năng chăm sóc nó suy giảm mà nên vợ thì sao xuyên ấy đây cô ở chung với lại cùng thì nếu mà trong sức khỏe nó không bình thường cô ở với cùng việc thêm nó lại tiêm vaccine rồi thì nó cũng thậm chí sốt rồi thì nó sẽ sốt khoảng cỡ hơn một tuần từ một tuần từ 1 tuần đến 10 ngày đấy thì sau khoảng thời gian sẽ bắt đầu nó giảm đi đấy giờ vừa rồi bên chỗ cháu kỳ mấy đứa nó tiêm một xong rồi bắt đầu nó sốt đấy thì không tại vì đã cắt thì không có làm test được tự đi nó không có nhanh về thì mình phải tháo được còn nó là nó làm sao còn nó là điện điện họ sống đi Đến cô thì của em tiền hầu đi tìm thứ hai xác định là không thể mẹ sau giờ mày có sức rồi mày đi ra phát hiện ra sao sao vậy phát hiện ra rồi đi rồi về cái test cho hai đứa ở nhà bán tiêm cái gì bán bị bệnh nền chắc là tiêm Moderna tại vì đợt vừa rồi ấy thế mà vẫn bị nữa thì mới được một mũi thôi mà với lại bán bị bệnh nền
C'est bon là?
So good evening, everyone. Pleased to meet you again for this new session, which is session 3 of the course today. Remember what we did yesterday. We tried to understand what financial analysis brings in the design of a financial policy, went again through liquidity solvency, question of return, question of the debt capacity. We spent time on that. We had a look also, second point, again on the architecture, the different elements to go through progressively. We started in session 1 with the investment, and yesterday we are more concentrated on financial analysis and debt, in order to bring into the financial plan the information needed to find if we have needs, financial needs or financial resources available. After that, we went on to the cash flows, spend time on the cash flows, okay, and we had discussion on the different categories of cash flows, what they are used for, and what are the difficulties also to calculate some of the different elements. So this is what we did yesterday. Today, we will move to some other topic. We start as usual with a question from the past exam. Then we move to the hybrid products. Third point will be on price earning and payout ratio with a few slides and a few exercises. Then we'll be back on the WACC calculation, cost of equity calculation with different cases, problem of leasing, of course, problem of taxes also. And we will have a few questions again on the relation between dividend, price earning, the payout ratio at the end of the session. That's what we will do today. I will start with, again, with the slides I used yesterday. And I move on slide number 3 here. I use the same set of slides I used yesterday. Okay, so I have 2 different sets. The first one is 93 number, and the second one is this slide you find here with the syllabus, the architecture, and then the 2 different exams. And I'm here on June 19. And June 19, I'm interested here by one of the questions which is in this exam, which is in the second page. I think so. Yeah, on second page. Part 4, question 2. So let's read this question together. The differences in cost and risk. In risk level, excuse me, for the same maturity and interest rate debts are explained by their repayment structure. Explain and discuss using infinite bond and equal annual payment repayment bond structure. It means the question is we take 2 different structures. I have 4 structures I explained yesterday and dealing with that, and let's say we have a hypothesis, a company, same issuer with the same risk, of course, issue an infinite bond and issue an equal annual repayment bond. They are issued at the same period of time, same maturity. We know the interest rates which is applied to this company, taking into account its global risk, business risk. Okay, and the question here is there any difference, in fact, in cost and risk level for these 2 issues? Same company, same maturity, same period of time. What's happened if you do that? Of course, the answer is positive here. Between an infinite bond and an equal repayment bond, what does it mean? It means that if you take the the company has to pay back at a point in time between the issue and the end of a life of a bond, you always find a higher amount to pay back with an infinite bond. Just because with an infinite bond, the company pays only the interest during the life of a bond. At the end, the last year, there is the last interest plus the repayment one shot of the amount which has been borrowed. Okay. That means, of course, the cost for the company is higher for an infinite bond because at the end, the total of the interest paid will be higher. And also, the risk for the lender is higher because at any point between the initial step between the issue and the last one, when everything is paid, there's always a higher amount to repay for the company. That means the potential risk of bankruptcy, liquidity, is higher at any point during the life of a bond. So you can argue that the cost is higher and the risk is higher for the infinite bond, cost for the company which obtains the loan, and the risk, of course, mainly for so that means that the structure is one point which has to be taken into account when you calculate risk and calculate the cost of a loan. This is not neutral, in fact. This is what I wanted you to understand with this question. So now what I want to do, I want to move to the other set of slides. It means 93. So I hope you get 93 now on the screen. I get it anyway. And I'm not interested anymore by the first elements here. But what I want to do, is to go into the slides to deal with hybrid products. So we are somewhere here. It should be 18. Yeah, 17. No, it's not 18. It's not right. Yeah, this is here we are. So let's have a look to the hybrid products who were here last evening. Yeah. I want to say a few words on hybrid products right now, okay? Because they are very useful in the design of financial policy. They are very useful, and we have different categories of hybrid products. We have many different hybrid products, but you can try to identify, let's say, families. And here I will deal with two of them, leaving for the next session, for session 4, the last one. So what are the three main families? The first one you see here, point 1, it's convertible bonds. Convertible bonds is number 1, okay? I'll come back in a minute on that. Second one is leasing contracts. And the third one, which is a bit different, is preferred shares. Preferred shares. What is the characteristic of all of these hybrid products? As you understand when you pronounce the word hybrid, it means it's somewhere between. It has some characteristics at the same time of equity and debt. That means instead of having a right side of the balance sheet with only debt and equity, we have a kind of continuity of the financial products between the classical ordinary share and the classical debt, straight debt, the two basic products we know very well. So let's have a look first to convertible bonds. What is a convertible bond? A convertible bond is made of two products which are, which are together in the same issue. The first one is a debt. In fact, in a convertible bond, you find a straight debt. It's a classical one. It could be, in most of the cases, it's fixed interest rates, but it can be also some kind of variable interest rate. But you find also at least an option. You find at least a call. A call depends on the issuer, which is the borrower, and would give the possibility. It is a possibility only to the borrower, to the issuer, to convert, to exchange the bond against a share during a period of time. It could be during 1 year, during 2 years, during the whole life of a bond, or at a point in time. Okay. So the simple convertible bond is a straight debt, fixed interest debt, and a call at the end of a life. But it can be much more complex. I mean, you can have different calls given to the borrower, and which can be used at different periods of time. You can have also an option in the hands of the lender. In order the lender can reduce the length, maturity of the life of the bond. So in that case, it's of course much more complex. And the value of a bond, takes into account the fact you have a debt, and the value of a debt is not so complex to calculate. We'll see that later. But you have also to integrate the value of the calls, of the options, which is a bit more difficult, particularly if you don't know exactly when this option can be used to convert, to exchange against a share. So we have complex models in convertible bonds. For those of you interested by that kind of modelization and valuation, could have a look to convertible bonds in Burke and DeMarzo. It could be complex to value. On the other dimension, which is not the dimension of valuation, but of a motivation, why firms issue convertible bonds? Generally, when you issue convertible bonds, it's because they want to increase their level of equity. It means they want to have shares. But they understand that if they issue new shares, an equity issue, this will increase the number of shares, without increasing in the short run, at least in the very short term, the net earnings, net income, which means the net income or net earnings per share will decrease. So this means an issue of share which reduce the wealth of the shareholders and will bring what we call in finance dilution of wealth or dilutions of value. And of course, a dilution of wealth or a dilution of value will have an impact on the value of a company and on the price of a share. That means for individual shareholders, for example, it will generally reduce the value of their portfolio. So they don't want this. They want to find some way to increase, in the medium term at least, their number of shares, their level of equity, but they don't want to have this dilution of wealth for shareholders and the decrease in value for the company. This is the first point. The second one can have a problem of control. I mean, you create new shares, you increase by 20%, for example, the number of shares, you get new cash, of course. But if you increase the number of shares and the shares are not bought by the original initial shareholders, that means the group of shareholders which is managing the firm can lose the majority. And a question of power can be raised. So this is what we call now the dilution of control. To simplify, the dilution of control is a reduction, a decrease in the percentage of rights of votes in the hands of a group of shareholders which is managing the firm. So convertible bonds are very often issued by firms who need new shares, new increase in equity, but want to escape or want to be able to manage the dilution of wealth or the dilution of control. We will say that at the point in time when the bonds will be converted, of course, there will be new shares. So you will have dilution. That's true. But what is expected? It is expected that during the mid-time, let's make the hypothesis, for example, the convertible bonds will be converted and exchanged 4 years later, 4 years after the issue. In the meantime, the company can have an increase in net earnings, net income. So that means the time of the conversion of the bonds, the net earning per share will not decrease. The trend of the net earning per share will not be a negative trend. It will increase by a percentage. So in fact, it's a process which dilutes the dilution of wealth over a few years and keep an increasing trend for the net earning per share, the value of portfolios of a shareholder, and the value of a company. It's a bit complex to understand. It's a bit complex if you're not familiar with that. I recommend you read Method de Marceau. And anyway, I will come back on that point next time in session 4 with examples. Okay. What kind of company is issuing convertible bonds? What kind of companies? If you have a look, you find many different categories of companies. Of course, your first perhaps reference are convertible bonds which are listed on financial markets, at least on all the large markets in the world, you find a category of products, convertible bonds, which are listed, and you can get a price and you can buy on the secondary market, as an individual, for example, or as an institutional, or as an investment fund or portfolio manager. You can buy and sell convertible bonds. So it's a marketable bond as a straight bond. But who is issuing on the market? Of course, relatively large companies. And if you have a look to bond markets, convertible bond markets, you can see that in many cases, these companies are belonging to one of the following categories. First one is large companies with high growth. They are profitable, but they have a problem of dilution of wealth because they have to finance their growth, and they don't want to be too diluted in terms of wealth or of control. Kind of company you can issue these bonds, for example, are the companies like luxury companies. They are growing very quickly, they have high profits, but anyway, their need of financial resources to invest is so high that they need more equity. But in the short term, if they issue more equity, they will be diluted at the same time on the wealth side and on the control side. So they use the bonds as a kind of a step, to be able to find solutions to manage these two dilutions. You will find also among large companies kind of company which can be of interest for you, which are state-owned company. In many countries, we have state-owned. In Europe, France is a good example of that. We had many nationalized firms, as we said, and progressively, different governments decide, to privatize or equitize, these firms. And one way to do it, was to issue convertible bonds. Because when you issue convertible bonds and you are a nationalized company, that means that sometimes you will increase the level of equity with new shareholders, but not immediately. That means the control will not be diluted, state control will not be diluted immediately, but progressively in the years to come. And behind this, what you find is not a financial issue, it's more a political issue. Because when you try to equitize, national or privatize, you have generally in the country, a group which is in favor, and another one of politician or even citizen which is against. So it's one way to postpone, the effect or consequences of an equitization. And it was very often used by that kind of company. The second point is that many state-owned companies who want to come on the market, use the stock market, are not very well managed. And the value of their share is quite low. And when the CFO issue convertible bonds, in fact, he get time, 3, 4, 5 years, to improve the management, financial management and financial situation of the firm. It means at the end, to sell to the market the share, the equity issue, and new shares at a price which is much higher than the value at the time it is decided to find new equity. It means if they issue convertible bond instead of issuing shares, they have the possibility between the time of the issue and the time of the conversion to improve financial situation of a firm, its productivity, for example, reduce the level of cost, develop marketing and commercial teams and so on. So this is something which has also been used for this reason. Last, among the large firms using convertible bonds, you find firms under restructurations. At a point in time when an industry, for one reason or another, is in a crisis and need new equity, an equity issue will be sold, the shares will be sold at a very low price. So the company needs the cash, but doesn't want the dilution. So one way to manage that kind of problem, to get the cash without getting the dilution, is to issue convertible bonds. This has been used in many different industries, like the car industry, for example. Each time there was, we're at the bottom of a cycle, it will be probably used in the bond for years to come by the airlines. That's a very good example, which is coming. So this is for large companies. And for years, the market was mainly a market for large companies. And many of these issues were listed in many countries. But now, and it's something which appeared what 10 or 12 years ago, we have a new market for convertible bonds. And the new market is for growing companies. And these growing companies, either in the sector, industrial sector, very well today, biotechnology, information system mainly. So when you start, create and start and develop the company like SWAT, you need equity. But the potential shareholders are very cautious. They think that it is risky, and this is correct. It's very risky. They can obtain good return, but they can also lose their investment, the amount of their investment. And they prefer in the first time to buy convertible bonds than to buy shares, just because the risk is different. A convertible bond is a bond. It doesn't mean, it's no risk, but the risk on a bond is lower than the risk on a share, for obvious reason. Okay. So very often, the first equity issues of these new, young, growing companies, are made through convertible bonds. And after a few years, when the growth is there, when the profits are coming, they decide to convert their convertible bonds into shares and to get, of course, the return on their investment. This is very, very common on that kind of firm today. So that means today we have two main markets. One for large firms, mainly listed on the markets, with different profiles, that's what I explained. And the second one, which is made of growing companies, small companies, much smaller issues in terms of size, but a large number of issues and companies coming on this market. In terms of financial analysis, you have got a problem because you are regularly calculating ratios with equity or debt, or financial debt. And the problem, for example, of return on equity calculation, or the problem of debt equity ratio will be raised. You have to put these convertible bonds somewhere that cannot be at the same time in equity and in financial debts. So there is a rule now in the accounting system, and it's really the application of the financial analysis of these bonds. While the bond, convertible bond, in fact, cannot be converted, because if you convert into shares according to the contract of the bond, you will lose part of your investment, because the value of a share, is much lower than the value of a convertible bond. In that case, it is clear that it is a bond, that it is a debt. But we find also the opposite situation. It means a convertible bond, which is such because of the increase of the profits of the business of the company, convertible bond which value is lower than the value of a share which could be obtained through the conversion. In that case, of course, the decision to move from convertible bond to share is a decision of the owner of a convertible bond, but it means that in its interest, present interest, he should convert, because he will get immediately a higher value. And in that case, we consider that it is part of the equity, even if on a legal point of view, it's still a bond. So it's somewhere between, and we need really this category of financial products, particularly in growing companies. And as you know, biotechnology is a growing company with a high level of profits, and is looking for more equity. But an equity issue, large equity issues in the short term will bring dilution of wealth and dilution of control. And the question can be raised, does an issue of convertible bond could help to solve this problem for biotechnology? So this is what I wanted to say today on that category of products. But if you are not familiar with that, have a look to Burke and DeMarzo, and we'll come back anyway with exercise and calculations. The second one are the leasing products or leasing contracts. You are more familiar with leasing probably than you are with convertible bonds, and some of you use leasing contracts. Now, we have some basic elements to underline. First one, we have different categories of leasing contracts. And in the accounting system, we make a distinction between two categories: the financial lease and the operational lease. And just really to simplify, we consider that financial lease as a financial debt, and operational lease as a classical lease. It means you pay the rent, and the rent will be deducted into the income statement. So in one case, it will be in the accounting system, it will be registered as a financial debt with, of course, the asset on the other side, even if the company is not the legal owner of the asset. In the other case, it will just be a cost. So you have this first distinction now. Let's say that in still a few accounting system, we have the old rule, and the old rule was based on the legal analysis of these contracts. When you use as a company an asset through a leasing contract, you are not the owner. Legally, you are not the owner. And our traditional accounting system was based on the fact that you take into account as assets only assets you own. That means in traditional accounting system and traditional financial analysis, they were not taken into account in the balance sheet. They were just taken into account, in fact, with the rent, the lease paid into the income statement. Okay. So that means the accounting system has moved and is more, let's say, more economic, less based on law, legal rules than before. And we have at the end accounts which are better representations of the economic situation of the firm, but which are taking into account, less taking into account the ownership basic principle of the traditional accounting system. So this is for the accounting side. Now, if you consider what is a leasing contract, you are a company and you want to buy a lorry, a car, transportation material, equipment, and you have several solutions. The first one is just to buy and ask for a debt contract to the bank. The second one will be to negotiate with the provider and try to obtain through this provider financial resources you need. It means many of them have a subsidiary which is a financial company, and financial company can lend you the necessary financial resources, and you pay the provider with that, and you pay back after that on several years. And the last one is a leasing contract. It means you go to a financial leasing company. Generally, this leasing company is a subsidiary either of your bank or of the providers, or of both of them, which happen very often. And the lorry, the car, is bought by this company, and this company keep the ownership up to the payment of the last lease, which is supposed to be paid according to the contract you sign with these leasing companies. So the leasing company binds to the provider. You use, of course, the car or the lorry, and you pay rent every month or every term or every year to the leasing company. But at the end of the process, when you have paid all the payments which are supposed to be paid, you get an option. So a leasing contract, in fact, is a debt. It's a debt for 100% of the value of your asset, plus a call, plus an option. And the option can be used only when all the monthly or yearly payments are really paid, and at that time, for a terminal value, you have a possibility as a company, as a user, to buy the asset and to become the owner of the asset. So if you compare, simple elements, most important elements, which are financial elements, the convertible bond contract and the leasing contract, at least for financial lease, they are very similar. They are made of a financial debt plus one or several options, because in these leasing contracts, you can also find several options. Means you can have an option at the end of the first year, at the end of the third year, and the last one, which is the compulsory one, at the end of the contract, let's say at the end of the fifth year. Yeah. So leasing contracts, convertible bonds, they are debts, in fact, straight debt, with all the problems of straight debt in terms of maturity, in terms of interest rate, in terms of currency, in terms of caps, in terms of floors, what we have seen yesterday, plus at least one call, but you can have several calls. A few words also about the history. When you have a look to the history of financial markets, you understand that convertible bonds were listed on the financial markets a long time ago. We find, in London, in Paris, in New York, in Frankfurt, we find issue listed before the First World War. It means around 1900, 1905, something like that. Which is quite interesting for those interested in valuation, because at the time we did not have the models we have right now. We did not know how to calculate the value of an option. And of course, we did not have the tools, equipments, computers, models, software we have right now. So prices were in fact proxies of the real value of the bonds. This is exactly the same for all the option contracts you find on the markets. I remember, the first model to value an option was published in 1973. Black and Scholes, perhaps you heard already of Black and Scholes. They had Nobel Prize. And before it means we had on the markets and between the banks options, for example, on currencies. And it was very difficult to calculate the value of an option. So we had method proxies, in fact. But the industry changed completely after the publication of the, let's say, modern model and the development of a capacity to calculate the value of an option through the model, and particularly through the first model, the Black and Scholes model, which is still on many products by many banks. So convertible bonds, you find them before the First World War, that's the beginning of the 20th century. This is not the case of leasing contracts. If you go to the history of leasing contract, you understand that the first ones were signed by the beginning of the 50s of the 19th century. It means, let's say, half a century later, if you compare to convertible bonds. And they were created mainly because we had a problem at the time in many countries of to finance the investment. It was after the Second World War, many destruction, we have to restructure, rebuild, and so on. And it was not enough resources to be invested in equity. So we had to find something. We wanted to keep the rules, like the debt equity ratio, and we had to find a solution. And leasing contracts, first leasing contracts, were signed to bring a solution to the rebuilding policy, restoration of industries, and so on. And at the beginning, they were concentrated, on a limited number of assets, like transportation material, very classical production equipment. And years after years, starting by the end of the 80s, beginning of the 90s, leasing contracts were extended to other kind of assets. For example, do information systems. They started with hardware, but now you have many contracts on software. They have been extended also to real estate by many programs, large program using refinance using leasing contracts also. So we have large possibilities for big projects, but also for much smaller projects like cars, for example, to use leasing contracts. And many banks and insurance companies in the world have a subsidiary or common subsidiary with other banks or insurance company or with producers, producers of car, construction industry, and they own their leasing company. That means they bring the financial solutions when there is a customer interested by one of their products, but doesn't have the necessary financial resources. One point which is of interest, one or 2 points. The first one is that leasing contracts finance 100% of an asset. It means when you ask for debt to a bank, generally, it depends on the country, it depends on the asset, it depends on the policy of a central bank at the point in time. They never finance 100%. They finance 60, 70 perhaps, but never 100%. It means leasing contracts help to solve also cash management problems. And this is an issue, at least at some point in the financial history. That's the first one. The second one is that, of course, a leasing contract has a risk which is lower than a classical debt contract. Same asset, same company, same players, and so on. Why? Just because, the lender keeps the ownership of the asset up to the payment of the last rents. Which means that, the customer, the user, doesn't pay for one reason or another. The owner is still the leasing company, and the leasing company can ask for the assets and resell even the asset to another company. It's much more difficult when it is only a debt contract with the ownership in the hands of the final user. So there's a protection, there's a guarantee there, and that means that when you are a lender, a bank, for example, and you have a customer, it is clear that the debt capacity you calculate for your customer is a function of ratio we already know, but it's also a function of your risk. And if the risk you get with the same company, same asset, is lower because you keep the ownership, which is the best guarantee, you will be perhaps willing to accept a higher level of debt. So leasing contracts aim to solve cash management problem, but also to increase the debt capacity of the companies. And this is one of the reasons why also you find many leasing contracts in growing companies, because at the same time, generally they have cash management problem, but they have also this difficulty of the limit in terms of debt capacity, and any process, any way to extend the debt capacity is welcome. Today you find, leasing contracts in industry which are very international also. The two main examples you always find on the books, articles on leasing contracts are first the airlines. If you have a look to how these airlines are financed, perhaps today the situation is a bit different because many of them have the funds coming from the States and they are nearly bankrupt. But in normal times, they own part of their planes, they rent on a classical basis another part, but they have also very often 1/3, 50%, sometimes more of the planes which are financed with leasing contracts. That means you have somewhere in the world, two very large companies which are financial investors. They are very similar to investment funds. And what do? They buy planes to Boeing, Airbus, and some others. And after that, they rent through classical rent contracts or through leasing contracts these planes to the main companies, to the airlines. So it's very central in the financial deals for airlines. And the second case is very similar. In fact, it's for boats. It can even for cruiser boats. It is done also for very specialized categories of boats like for transportation of gas, oil, and so on. So a very technical system, and they are mainly financed using leasing contracts. That means also when you have a look to that kind of views, it's really also project finance. A boat is a project, has to be built, and after that, it's contract and it's moving around the world, and cash flows are coming, and in fact, cash flows allow the payment of rent. So it's project finance plus leasing contract, which is debt plus a call. So this is also very common, and we have progressively more and more extension of the leasing contracts. So both of them, convertible bonds and leasing contracts, are hybrid products. They are in the balance sheet, they have to be somewhere between equity and straight debt. Anyway, when you analyze them using ratios, you have to rank them in one of these categories. And we have an argument on the relative value for the convertible bonds. And for the leasing, they are always, supposed to be kind of debt categories of debt with a specific option or specific options depending on the kind of contract which is signed. I said just a few of that because we will go into more details. The category of hybrid products. And the third category is what we call preferred shares. You have a clear structure in your mind. What is a preferred share? What is a share? You get a share. Right? you buy a share on the market of the company, you are the owner or part of the firm are invested in, a small percentage. Second, you have a right, which is to be a member, to be a member of the annual meeting or any other kind of meetings of shareholders. And in this meeting, you have a right of vote. It means you are part of the group of shareholders who take the main decisions. Nomination of the CEO, members of the board, CFO, strategic decision, main acquisitions, that kind of thing. Okay. So this is the second point. And the third one is that you have a right to dividend. It means each year you will receive a dividend, which is part of the net income or net earnings. You know the process. We have been through this process before. And of course, you are not only in a position to get the dividend, but you are in the position to decide what would be the dividend. You are the decision maker, and you are also the one who receive the dividend. So this is a classical share and the classical shareholder. Now we can modify partly these rules. And you will find different categories of preferred shares. The first category of preferred share is very simple, very, very simple. It is a share without a right of vote. That means, in fact, we create shares, classical shares, ownership, right of vote, right of dividend. But after that, we cut the share into two different products. The first one is the ownership plus the right to dividend. And the second one is the right to vote. And you raise the question, what is it for? Try to think to mainly family-owned companies. They are growing, they are profitable, but they need more equity. Perhaps they are wealthy, but not enough to finance the growth. Sometimes they want to lose the control of a company. That means they don't want to sell the rights of votes. They want to keep the rights of votes of the new issues. But they are willing, they accept, to leave part of the ownership and part of the dividend. So this is a product which is really very good product for medium-sized firm, family-owned, high growth. And this is one of the preferred shares we know. In fact, in the preferred shares like that, you have two different financial products. On one side, you have the ownership and the right to dividend. On the other side, the right to vote. Okay, and it is organized the following way. At the beginning, the firm issue new shares, but in the contract of issuance, it is said that after the issue, all the shares will be split into two financial products, two preferred shares. One will be only the right to vote, and the other one will integrate the other dimension, the ownership, plus the right to dividend. Of course, the preferred share which is made of the right to dividend plus the ownership can be sold to anyone, and the right to vote is kept by the family, which control the firm. So this is the most simple one. You will see in one of the cases we use in the company valuation course that we can have different categories of preferred shares. You will accept perhaps to buy a share only with the ownership and the right to dividend, but without the right to vote, right to control. If you believe that the management of is a very good team, performing well, able to maintain in the long run high growth rates, high profits, and so on. If you are not so sure, you would not accept that product, but you could be interested by another one, which is based on the same principle. I take a share, I issue a share as a company, and I want to keep the right to vote, control. But in order to sell the other part, the ownership with the right to dividend, I have to give something more. And in fact, what is given in that case is a higher return. And the higher return is not an increase in the dividend, but it is an interest. It means many preferred shares are made, of two preferred shares. On one side, the right to vote, the control, as the preceding example, but on the other side, the ownership, the right to dividend, plus an interest rate. So that means what you find in that preferred share is a higher return than on the standard ordinary share. But at the same time, this return is partly a dividend. It means flexible according to the decision of the annual meeting, but also it's an interest, which is a characteristic of a debt contract. So with the ownership and the dividend, it is part of the equity, but with the interest-based return, it has also characteristic of debt. And this is also an hybrid product, which is between the ordinary share and the straight debt. This is very popular for different categories of companies, and mainly for two categories of companies. The first one is the family-owned firm, generally medium-sized family-owned firm in the industry, and also it has been used by state-owned companies. The state-owned companies want to get more equity. The state doesn't have more resources available, and or want to have a policy of equitization, But very often it's difficult, to find shareholders because, individual shareholders, they don't have a good opinion of the quality of the management of state-owned companies. So if you try to sell them even with a discount, a preferred share, including only ownership plus the dividend, they don't want to buy that. They want something more. They want an interest. Part of the return should be an interest. It means something which is in the contract, something which doesn't depend on the decision of the annual meeting, where the state is dominating. Yeah. So state-owned company use that kind of preferred share, but also family-owned company. At the beginning, when it was created in many countries, it was designed to improve, the financial structure of the family-owned company, medium-sized, classical, traditional family-owned companies. But progressively, the state found that it was of interest also for its own operations and the firm under its control. So that's the reason why we have these two main applications. But you understand that all these three kind of products have some characteristics of complexity first. They are complex products. They are somewhere between a traditional standard and the traditional debt as trade debt, with different characteristics. And for companies with high growth, risk, problem of control, problem of dilution of control, problem of dilution of wealth, very often they are used. It's also one way to bring more cash with the leasing to help you solve management, cash management problem, to limit the risk of the lender, which allows to increase the debt capacity level. And this is also the possibility with kind of optimization of the interest for preferred shares to attract shareholders, which will never invest in companies by the state. So we have different elements in favor of these hybrid products. One of the difficulties we have, of course, is to modelize. We have several difficulties. The first one is the calculation. Calculations of consequences, calculation of values, calculation of the elements taken into account in the options. They are much more complex than in classical product, equity or debt. Second, it's very difficult to understand before we issue if you will succeed or not, particularly for preferred shares, particularly for convertible bonds, perhaps less with leasing contract, because it's difficult, to understand what will be the behavior of the potential buyers. You reduce the risk, you give them an interest for the preferred shares, you bring them a possibility to move and to convert the convertible bond into a share and convertible bonds, but also to stay as a bondholder. What is the importance of that compared to the other problems? Means the dilution of wealth, the dilution of control. It's very difficult to estimate. So at the same time, it is complex in terms of design, complex in terms of calculations. It brings several good, useful advantages, but it is also difficult to understand, to catch the behavior of potential buyers, investors in front of the proposal integrating these products. Yeah, this is what I wanted to say on these hybrid products. We have possibly we have some of them integrated into exercises and calculations at the same time in this course, but also in the company evaluation course. I was there. Now we are here on slide 21. After slide 21, what we can do is have a look to some questions again before moving to another topic. So for the questions, I will go back, to my other set of slides. Trying to do that, which is here. That's it. Hope you see again, let's try again, do it another one. Yeah, it should work. And of course, my interest here is for a few questions which are in the two exams you find in that set of slides, which are the exam for year 19 and the exam for year 20. So I get a few questions, and here I am. I am in June 2019, and in June 2019 I have questions which are related to the topics I just went through. You get question which is above here on the screen. I hope you see my screen, my slide, which is question 1, part 4. Question 1, part 4 here. In the 2019 exam, which is slide number 4 here. And if you have a look to this part 4, you had a choice between two questions. The question 4.2, and we went through this question. We started the session today. And question 4.1, which is a question I raise right now. Leasing contracts are used to increase the debt capacity of a firm. Explain and discuss. It's very easy if you followed what I said. Leasing contracts are 400% of an investment, of the value of an investment, not like a debt contract for 60, 70, something like that percent. So that's nature of the contract increases the level of debt. But the second argument of main explanation is that with a leasing contract, the risk of a lender is lower than with a debt contract. Just because the lender, the leasing company, keep the ownership up to the end of the payment of all the rents. It is only when the total value, in fact, of the assets plus the interest on the total value has been paid that an option, a call, can be used, and the user can buy for a residual value, a terminal value, the asset and get the ownership. Okay. So ownership is probably the best hedging process, guarantee you can find, and this is brought by the leasing contract. This is the question I wanted to show you here. And I will move to another question. which is in the other, there's another one somewhere. It is in the here. Excuse me, I'm looking for that and it's difficult to read here. Yes, I'm here. What you can do now is to move to slide number 7, which is a slide on the other exam. And you go to part 4 again, and we find 2 questions there. One on convertible bonds, and the second one on the leasing contracts. So you get another question, question 1, which is a bit more difficult than the preceding one. Let's read it. Leasing contracts are used to increase the debt capacity and decrease the weighted average cost of capital of a firm. Explain and discuss. So we already answered to the first part. Of the preceding question in an exam from 2019. It is clear that we have an increase in the debt capacity, and we have a reduction in the risk of a lender. But now, there is another point, which is to decrease the weighted average cost of capital. Why? Just because, if you finance an asset with 70% of debt and let's say 30% equity, we calculate weighted average cost of capital. We will do that in an exercise in the second part of the session. And now, if you eliminate the equity and you replace at the same time the debt and the equity by a leasing contract, what's happened? Actually, what's happened is very simple, is that the leasing contract is more costly than the average cost of debt, but it is less costly than the 30% of equity. That means when you mix the 30% of equity and the cost of the debt, and you compare it to the cost of a leasing contract, you find a loss of a leasing contract. Be very careful. Some even analysts are confused. They say leasing contracts are always more costly than any other structure. But we don't take into account that in many cases it reduces the amount of equity to be used. And that means that if you have an average cost of debt, which is, let's say, 8%, an average cost of leasing, which is 10%, but the cost of equity, which is 18%, when you make the calculation at the end, you understand that the introduction of leasing, introduction of leasing reduces the average cost. That means company using a large percentage of leasing, for example, transportation companies, generally they reduce their weighted average cost of capital using leasing contract because they eliminate increases in equity, which are more costly than the traditional debts and also than the leasing contracts. So this is the first question. The second one now, second question, Second question is on convertible bonds. And he said convertible bonds are used to increase the debt capacity of a firm, but also to postpone the wealth and control dilutions. So this is what I tried to explain you. is a resource, financial resource, which is somewhere between also the equity and the straight bonds. And generally, you obtain more with convertible bonds in terms of loans than only with bank loans and straight bonds. It means it increases like leasing the debt capacity. But also it postpones, and this is the most interesting point, the dilutions. And it postpones dilution because if you have finance a new asset, a new investment with convertible bonds, you don't issue new shares. You will have issued if it was financed by equity. So the number of shares doesn't increase, at least immediately. In the short run, you don't have any change in the earning per share, in the net earning per share, and in the wealth of a shareholder. Perhaps in the long run, it depends how you will manage financial structure in the meantime. Okay? And for the dilution, it is the same, because when you create new shares, you create new rights of votes. And the original shareholder, if he don't participate to the new financial resource issue, because he doesn't buy new shares, they will be diluted. It means their percentage of rights of vote will decrease. So if the equity issue is replaced by convertible bonds, at least for a few years, you escape to the dilution of the control because there is no increase in the rights of votes. But that means that during these few years between the issue and the conversion, you have to modify your financial structure in order to manage both dilutions. Okay, this is what I wanted to show you with these questions. Now let's come back, if you don't mind, on the other set of slides between 93 with another topic. Let's see that right now. I hope you will see my slide. Okay. So we are back. You should have again on your screen the slide with hybrid products, which is number 21. And after 21, there is 22. And we are moving to another topic. We have been through risk and maturity, through hybrid products, a few questions on hybrid products. And now we are dealing with something different, which is a multiplier, what I call the multiplier, and some elements of understanding, explanation, and calculations there. So what you find here is what we call the simple valuation model. We will see progressively many different models of valuation. You already, anyway, a few of them. You are already familiar, at least, with basics of a capital asset pricing model, which is very central in modern finance. We went through together some multiples in financial analysis, like multiples taking into account EBITDA. You are also familiar with other kinds of modelization like this one, because this is not the first time you heard about the simple model. We didn't call it simple model. which is the relation between the price of share, P, the earning per share, and a multiplier, which is the price earning. I'll call it PE, like it is here, or PER, a price earning ratio. It is the same number. So the hypothesis is that the price of a share is equal to the earning per share multiplied by a multiple, and we have to deal and to explain what is this multiple. This is also still point one here. The fact that the value of a firm, according to this model at least, is equal to P, which we calculated in the preceding line, multiplied by N being the number of shares existing in the company. V equal P multiplied by N. And now if you replace P by EPS, earning per share, and the price earning, the multiplier, now you find the equation which is here. The value of the company is equal to the price multiplied by the number of shares, to the earning per share multiplied by the PE, the multiple, multiplied by the number of shares. So that seems to be very, very simple. What can you say? You can say at the beginning that PE is a kind of multiplier, and that in fact you don't have any specific element to find it in the accounting system, for example, and that either it is a result of a calculation. That means if you divide the P by the price of a share, earning per share, you find this multiple, which is one way to do it. Or you have to find it from outside the firm, benchmarks, comparisons, standards, which are accepted in the economic sector where you are. Point two, it is a multiplier. What does it mean? It means you can explain it as a number of years, how many years of earning per share as the earning per share is now. How many years of earning per share as the earning per share is now. Investors are willing to pay. If I want to buy a share, I have a look at the market, and how many years of earnings I'm willing to pay to become the owner of a share. Price earning is different. It's moving. It will be too simple if it was constant. And it is different for different firms, for different economic sectors, for different firms in the same economic sector with different business models also. So we understand that rules are very difficult to find in order to tend to get the price earning. Point three, we know that all price earning, whatever they are, whatever is the firm and the right, are volatile. Volatility is one of the characteristics of this multiplier. And we understand very quickly, or having a look to the result, and we have many tests, good articles, theses on that, that the level of PEs are correlated to some basic data we have. The first one is that there is a correlation with the level of long-term interest rates. Be careful to what I say when I say correlation. It can be an inverse correlation. That means when the long-term interest rates are going up, the price earnings are going down. And this is very clear and understandable without any kind of model. When the interest rates are going up, you are more willing to invest your savings in long-term bonds, government bonds, than in shares. On the contrary, when the level of long-term interest rate is going down, which is the case today, which is for government bonds is very close to zero, in some maturity it's even negative in some countries. You don't invest your cash into long-term bonds. You have better to invest it in shares, which is an explanation of the level of the stock market also today. Second, it is also correlated with something else, which is liquidity level. And liquidity is there again. Remember that liquidity is something central. Liquidity has a value. Why? Why? When you have high liquidity is easy to obtain from the banks, for example. What does it mean? When central banks are developing, increasing the liquidity level in the economy, they do it generally, by different ways, lending more easily liquidity to commercial banks. And commercial banks, of course, when they get liquidity, what do? They lend more easily at low cost to their customers. And second, that's what we do today. Central banks are buying back assets on the market. They are buying bonds, they buy governments or state-granted bonds, and then they start buying shares. And of course, they increase the level of liquidity on the markets. And when you have high liquidity in the hands of the final investors, the consumer, the firms also, what's happened? Generally firms, increase the level of investment. They also keep part of the liquidity in their accounts. And individuals, household, what do? The average amount of the check accounts is increasing, but also, they invest part of this liquidity. And when they invest part of the liquidity, what can they do? Generally, two things. First, real estate. And in many countries, real estate prices have been going up for the last years, partly because of the low level of interest rates, long-term interest rate, but also because liquidity is available. You go to the bank and they finance you more easily than 10 years ago. But second, it's not enough. And they need other possibilities to invest. They invest their liquidity on the stock market. So, as the short-term earning per share is not going up, it's quite stable. This increases the prices, the demand as per consequence increases the price, and of course, because of the equilibrium of the formula, an increase in the multiple. PE is a function at the same time of a level of long-term interest, which is what you find generally in the textbook, but also, and this is what we are living with today, of a liquidity available on the markets, in the banks, and then for the final consumer investor, companies, and households. So this is a basic explanation for price earnings. Now, a few points here on the slide. First, again, all price earnings are volatile. It means they are not stable at all. They are moving up and down, moving up and down. And they, of course, they follow the volatility of the stock market. And we know that if liquidity, liquidity for share, for example, is a variable which can explain part of the growth of the price. Just because when you buy a share, if it is liquid, it means if it is listed on the market, if there is regular volume of exchange in the market, you believe and you're right that if you want to resell or to buy more shares, it will be easy to do, that your risk of liquidity is close to zero. So the fact you bring liquidity to the shareholders or to the investors brings more acquisition of shares, more investment of the stock market, which means in the end, increase the prices. So more liquidity generally brings higher prices. More liquidity creates more value. On the other hand, volatility, which is the fact that prices are moving sometimes very quickly inside the same day. It means if you want to modelize volatility or to calculate volatility, you can practically like the difference in terms of percentage between the highest and the lowest price in a day. And of course, these when the differences increases, the investment in that company is more risky. So more volatility is more risk. And risk is just contrary on basic finance, back to basics, to return. When you increase the potential return, you create value. When you increase the potential risk, you destroy value. So all PEs are volatile, and the highest the volatility, the lowest the PEs, all other elements being stable. Second, that's what we've already said. The stock market PE is moving up and down according to long-term interest rate. Yeah, what I said a few minutes ago, 1 for 1 share. Here it is for the market as a whole. And when we say the stock market PE, you can consider that it is the PE of a portfolio share, which is a good representation of a stock market. You can say it is the largest diversified index, of the stock market. For example, we consider generally that for the New York Stock Exchange, the NYSE, the best representation of the stock market is the Standard & Poor's 500 index, not the Dow Jones, the Standard & Poor's 500. It's much more diversified, 500 companies instead of 30. And that this index is moving up and down according to different factors, to long-term interest, right? It's an inverse relation, but also according to liquidity level available on the market and to volatility. So the stock market as a whole, with a representation which is the largest diversified index, which is a good proxy of a market, is explained partly by long-term interest rate, by liquidity levels, and by volatility level. So for 3, we know that these are also sensitive to the liquidity level, and by the changes in liquidity levels, and to the level of risk perceived by investors. And of course, volatility is one of the components of the risk perceived by the investors. You can find others, and they are not independent one from the other. It's become much more difficult in terms of calculations. For example, you can say that the pandemic brings risk, the price earnings are sensitive to the level of risk and pandemic risk. And if you remember what's happened on the stock market at the beginning of the pandemic in February 2020, very quick decline of stock market level. That means the investors, believed at the time that the risk was mainly a sanitary risk, and the PEs went down and were divided by 0.4, 0.5, something like that. But that means also, and this is much more complex again, that the relative PEs are also moving over time. It means the price earning of the company in the steel industry and the company in the luxury industry is not the same. But if you will have a look, just give you a few numbers. If you think that the steel industry in the world, has a price earning today, which is about 10, and the luxury industry has an average price earning which is about 30, with an average price earning in the stock market which is about let's say 18. These three numbers can move. Not only the 18 will move, of course, because of the risk perceived, because of volatility, because of the liquidity, because of the long-term interest rate. But it's not sure that the 10, the 18, and the 30, the 3 PE of the steel market and the luxury industry will move the same. Perhaps in 2 months from now, for steel industry, it will be 8, it will be 17 for the stock market, but it will be 35 from the luxury. Because you get also, changes which are due to a situation in each economic sector. If we have reduction in the growth rate in the economy, less demand for steel, and more production of some steel countries, some recent country like China, for example, probably the PE for steel industry, steel companies will go down. But on the contrary, if we still have liquidity available, increase of liquidity, and if growth of the economy is increasing again in some countries with many buyers of luxury products like China again, for example, Japan, we have luxury PE going up. So you can have luxury product PE going up, steel industry products going down, and the market somewhere between, perhaps in my example, moving down by 1 out of 18. So relative PEs are not stable also, even if you will probably never find, at least for years, a PE of the steel industry higher than the PE of luxury products. But anyway, the difference between them can move over time. So all these multipliers are moving for different reasons according to different explanations, different parameters or variables also. And this is not stable over time, it's moving over time. So that's explained also that when you have a look to the values of companies on the stock market, they have been moving very quickly. And if you went back 20 years ago, 2000, what were the most valued companies in the world in 2000? At least on the largest stock market like New York, London, and so on. You find all the energy companies. Exxon was always among the three higher value. You find the car industry, GM. GM is not anymore in the list of the most valued companies. You found also large banks. And all these companies you use the products and services every day right now, companies belonging to information systems, they had already an important value, but they were not among the first ones. And also, if you have a look to some other kind of companies, I think, for example, to cosmetic company, I know very well a firm which is called L'Oréal. L'Oréal is generally well known also in Vietnam. All the department stores, you find products from L'Oréal, and ladies know that very well. Now they are among the three more valued companies in France. And you know what is the most valued company in Europe today? It's not Mercedes, it's not Total or Shell, it's not the steel industry, it's not any kind of a pharmaceutical economy and firm. It is LVMH. LVMH, Louis Vuitton, Moet Hennessy, luxury products. If I have said that 20 years ago to my students, saying in 20 years from now, my forecast is that the LVMH will be the better valued companies in Europe. They will have laughed. They will have said, this guy is completely wrong, not good in finance at all. And that's true. So it's really moving, not only in the short term, but also if you have a look to longer period of time, you understand that some industries, in fact, in terms of valuation, are moving up, price earnings are going up, net earnings also, and some of us are going down. It's not a stable environment. So that means PE, it's something you can use, but you have to be very careful because it's not stable. This is what I wanted to show you here. We are also in a very, very specific period of time in financial history, because we never had such an effect of a liquidity level. Because we never had, and I will come back on that later, such a level of growth of a liquidity level in the banks and the economy. And the best measure of this evolution, and you can follow that easily, you find it on internet. It is the size of the balance sheet of a central bank. If you have a look to, I will show you this graph, to the total of the balance sheet of the Fed, the US central bank, during the last 10 years, it has been multiplied by 12. What does it mean? It means it has been multiplied because two elements of it. First, central bank finance directly the economy, bringing in very, very good conditions new loans, new liquidity to the banking system. And second, they bought back assets on the market, bonds and now buy shares. That means, they are keeping the shares and the bonds, and they are giving back to the investors, liquidity. And this liquidity out of that is used, of course, in the consumption, in investment, and so on. That means the level of liquidity is a variable which weight in the explanation of what's happened, and particularly the level of multiplier has never been so important, never. Okay, this is what I wanted to show you up to that point. It's nearly 9 o'clock for you. That goes 2 minutes to 9, to 9 now. And what I'm trying to do here, after dealing with hybrid products, is give some idea on the multipliers, on the factors of influence, liquidity, volatility, interest rate, long-term interest rate, which is a classical one, very well explained in the textbooks, in particular in Burke and DiMarzo. And I tried also to explain that this is not stable at all. Doesn't mean that P is not important in the calculations, because we are very often short term. But anyway, in a few months and in a period of 10 years, of course, it is moving, and situations can be very different 10 years after what, if you compare to what you see right now. My next slide will be on the payout ratio. So it is just 9. Let's have a few minutes break, and I come back with you on slide number 24. And slide number 24 is on the payout ratio. Okay. Thank you. Let's have a short break. No more than 10 minutes anyway. Okay, so I think we can perhaps start again, because we have many other topics to go through. The next slide is 24. It's a slide on the payout ratio. You will see in many exercises, many documents, POR, payout ratio. What is it? Just let's explain that again. Payout ratio is equal, this is point 1 here, to the dividend paid to a shareholder per share, divided by the net earning per share. It is a percentage of the net earning which is distributed to the dividends. You can also make the calculation at the level of the firm. All the dividends paid to all shareholders divided by the net earnings or net income, what you find in the accounts, is also equal to the payout ratio. So just a calculation and a definition. Second point here, payout ratio level are different from different companies for different economic sectors. You find some kind of tradition, but you have perhaps more better explanations in terms of business model or in terms of financial situation. You find very low or even equal to 0 ratios for companies in growing technologies. I probably said that already, but a good example, you find in many books is Microsoft. Up to 1995 was no dividend. At that point in time, in 95, it was decided by the board to make a proposal to the annual meeting of distribution of dividend. And during this meeting, majority of the shareholders said, no, we don't want a dividend. We prefer you keep the cash you wanted to distribute and you reinvest in the firm. Why? Why? Just because, the majority of the shareholders thought that the return they can obtain by themselves on the cash distributed through dividends will be lower than the return obtained on the same amount, same cash, by Microsoft management if the dividends was not distributed but moved to retained earnings. So the decision of the annual meeting was a decision based on a comparison of potential return, the one obtained in a reinvestment in the firm, in Microsoft, and the second one, a distribution and different returns, or an average return obtained by all the shareholders with the cash they obtained. And that's, as long as the return offered by the companies are higher, you can expect that dividend will be equal to 0 or very low, just for few shareholders who want to get some liquidity for their investment. You find also situation specific, which is big situation of biotechnology. A payout ratio equal to 0 for growing companies showing losses. It could be the case, it depends what you will do, but you should have a look to the years 2001, 2002 mainly, and try to understand what is done. When you have the profit going down suddenly, when you have at the same time the investment level going up, when you have financial needs increasing very quickly, is it really time to distribute dividend and to have to issue different from zero? One of the issues there, and we'll go into that, is what about the signal you give to the shareholders in the market? What is the dividend and what is the payout ratio? Is it just a problem of cash management? Or is it also a problem of what we call in financial theory, signal? And the question would be simple, and you have to solve this question for biotechnology. Don't you think that, or you have two issues, or two solutions, two scenarios. The first one is, okay, they have an increasing needs of new financial resources, and that is not adequate to distribute at the time. And you have a second interpretation, which is, of course, they need large amounts of new cash through equity issues and through debts. But if you want to launch with success a high level equity issue, you need to be very kind with the shareholders before. And among the measures you can take, a dividend distribution could be a good decision. So even if you know that the firm has a financial need which is increasing, you are better to make a distribution of dividend and a few months after to launch an equity issue. You know, it's something which has been tested very often in colleges. You know, you want to borrow money to someone else. If a few days, a few weeks before you make a present to this person, probably it will be easier to obtain what you want. And this is the same situation. So this has been studied empirically, modelized, and this is what we call the signal theory, which is part of communication, in fact. You have a situation which is traditional also, which is equal to zero for non-profitable company, or that kind of company, which is maturity sector, margin of decrease, competition is high. They don't know how to solve their problem. They try to survive, and they don't distribute payout ratio is equal to zero. You have a problem with banks in the period of crisis. The example of how we have known these last 2 years is very good. What was decided by several central banks? I think to the Japanese, I think to the Bank of England, I think to the European Central Bank and to the Fed. They have decided early in 2020, at the beginning of the pandemic, to either reduce drastically or even to suppress the dividends for the banks according to the situation, the balance sheet, in fact, of these banks. And that means that in 2020, a large part of the banks in at least the New York country, we are not allowed by the central banks to distribute dividends. If you follow that kind of relation between the central banks and commercial banks, you understood probably that the situation is much better than it was a year ago, and that they were allowed this year to start again making distribution of dividend. A payout ratio can be very high for some kind of companies, particularly for major companies. This is the situation in the petroleum companies, if you have a look to Shell, to Exxon, to Total, you have very high payout ratio with high return compared also to the price of a share. And this is generally true on real estate companies. Very often you find real estate companies payout ratio which are close to 80%. So, you know, you can have different situations for different companies at different periods of times. So payout ratio is something which is adapted to the business model, adapted to growth, expected growth, and growth which has been obtained in the last few years, to the macroeconomic or macrofinance environment, pandemic also, which is also taking into account the returns of the reinvestment of the dividend and the distribution of this dividend. Okay, so now let's have a small exercise. The example is the following one. We suppose we have a company with a 40% payout ratio. Okay. The last dividend is €5. Last distributed dividend is €5. The average price earning calculated on the last 3 months is 12. That means you take a calculator of the market less ratio. And the question here is what is the earning per share and what is the price of a share, or proxy of the price of a share. So the earning per share multiplied by the payout ratio is equal to the dividend, which means here the earning per share, it is the variable we are looking for, multiplied by 40%, which is a payout ratio, is equal to €5, which is the level of the dividend. Which means if you modify the order of the different elements, that the earning per share is equal to the dividends divided by payout ratio, 5 divided by 0.4. And you make the calculation and find 12.5. The earning per share here is equal to €12.5. This is number 2. Number 3, here, if you have a payout ratio of 40%, it means 40% of the earning per share is distributed through dividends to a shareholder. That also means that 60% of the earning per share is kept into the company in retained earnings. And if you make the calculation, it is €7.5, and you understand that €5 of dividend to 7.5 of retained earnings is equal to the earning per share, which is 12.5. Now you use, and this is very classical, the price earning you have calculated on the market. It means if you take, as it is said here, the last 3 months, January, you know, we have 20 to 22 free days of quotation. It means you find the 20, let's say 22 average PE for each day the markets are open. You make the average of these averages, and you find the number 12 here. So the price earning you got here is a calculation of average or weighted average, can be weighted by the volumes of transaction for each day, but using past data. It's always the same problem we find in financial analysis. We use past data to try to make forecasts. So we use it. Okay. We use the price earning, which is 12. We have the earning per share, which is 12.5, and 12.5 multiplied by 12 is equal to 150 euro. So a proxy of the price of a share, is 150 euro, using the payout ratio, the level of allowed dividend, and the price coming from outside. And outside could be the stock market, but could be also some comparable. If you are doing the calculation for a firm which is not listed, again, you will try to find comparables or average in the economic sector to which this firm belongs, and get this value, you need to make the calculation. Okay. So the number 12, you have to be very careful when you calculate 12, because at the same time you have a problem of benchmark, reference, comparable, and a problem of period of time you use past data to make to calculate a proxy of the price today, and we use it also on the future calculation. Now, question 5, what's happened if the price earning ratio decreases to 10? It's some my preceding presentations a few slides before. We had price earning of 12, now it is declining to 10, and this is due to an increase in the long-term interests. This traditional relation you find in the textbook. What's happened is the PE, because of long-term interest rate going up, the PE is going down. A share price becomes 12.5, the earning per share multiplied by 10, which is 125 euros. What does it mean? It means that in the short term, at least, the price and the PE are more sensitive than the earning per share. The earning per share will be affected a few months after, or 1 or 2 years after, because of the increase of the interest paid, perhaps of a decrease in the demand also, because when you have long-term interest rates which are increasing, the investment level is going down, and generally the demand is also going down. But it's much more the sensitivity is appear quicker, and it's more important, on the price earning and the price rate, the price earning, the price of a share than the earning per share, which is an accounting-based calculation. So this is an example, of basic calculation on a multiplier. We were slide number 25, and we are moving now after this exercise and these different slides on PE, payout ratios, multiplier, and this will be very useful for the future and for your understanding of what could happen on biotechnology in the periods to come. Now let's move to another topic, which is the fourth topic for today, after the question on risk and maturity, after the hybrid product, after PE, price, POR, and multiples. Let's move to another kind of problem, calculations of cost of debt, cost of equity, weighted average cost of capital, and so on. We'll present a few ideas and use an exercise which is in one of your 2 past exams you get on your the other set of slides. when you say cost of debt, you have to be very, very careful. What are you talking about? First of all, is it financial debts? Or is it all debts, which is a bit different? And generally, the answer is that it is financial debts. That means that operational debt are analyzed, considered in calculation, which are not calculation of the cost of debts or weighted average cost of capital, but are taken into account, incorporated, analyzed the operating working capital. It means operational debts are compared to inventories, to receivables with either operating working capital, but this is not included in the calculation of the cost of debts or weighted average cost of capital. Remember what we have done in the presentation of the balance sheet. So we are dealing with financial debts. Point two, when we say debts, now it's financial debts, before and after taxes. And the fact you take into account, don't take into account taxes, could modify, the results and the decisions. And we have an example of that kind of calculation. Remember also that profitable and non-profitable companies are not in the same situation. That means that costs of debt is final cost of debt is different from profitable and non-profitable company, is also a function of the level of the tax rate. So profitability, non-profitability, level of the tax rates are two variables to take into account. Point two. Point three, what do we do of short-term financial debts? Point three here. Now, this is always a question which has been raised in finance, and it is clear that the answer is different if you deal with the debt capacity or if you deal with calculation of cost of debts and of weighted average cost of capital. For the leverage, debt capacity analysis, generally, we don't integrate the short-term financial debts. We integrate them in the calculation, and this is just a question of analysis only if these short-term debts are recurrent. I mean, if a company thinks that it's much better, instead of having financial debts 100, a long-term financial debts 100, but to have 80 in long-term financial debts and 20 in short-term financial debt, because in their financial environment, short-term financial debt are always available and always less costly. Can you consider that they are short-term financial debt, or they are recurrent short-term financial debt to be included as long-term financial debt? No. So again, you have to analyze the case in detail. But that means that if short-term debts are really short-term debt, it means, for example, you have a short-term debt for 8 months a year, and during 3 months, 4 months, you don't have any short-term debt. They are not taken into account in the calculation of the leverage and debt capacity level. But anyway, they are calculated, they are integrated into the calculation of the cost of debt, the average cost of debt, and the calculation of the weighted average cost of capital. So you have to be very careful on the real nature of the short-term financial debt position you find in the accounts. Point 4 will be on leasing contracts. And what I said before, leasing contracts have to be integrated in the balance sheet and in financial resources when they are financial leasing contracts. And in that case, they have to be considered as being financial debts. Okay. And the consequence is what we discussed in one of the questions of the past exam. It is when you replace equity by leasing contracts, because leasing contracts allow you to increase your debt capacity, the impact is a reduction in the weighted average cost of capital. We'll come back on that point with calculations. Point 5, cost of debts should include convertible bonds in most of the cases. Because in most of the cases, convertible bonds are bonds. On the financial point of view, on the legal point of view, they are bonds. But they can be considered as being equity if the relative values of a share and the bonds and the parity are such that the interest of a shareholder should be to convert. For several reasons, you can say, okay, I don't convert. He is a position of a lender, not a shareholder, less risky. Perhaps he anticipates that the price of the share will decrease for one reason or another, because of the economic situation of the country, for example, or because of its tax position, depending on the country and the regulations in terms of share income, share revenue taxation, and non-bond taxation. Can have different situations. But you have to analyze the convertible bond, as I said when I presented the convertible bond at the beginning of the session. So that's the kind of problem you will find here. So we have to move, if you want to follow that, we have to move to your one of the final exams. So you get also the final exams and you can follow both at the same time, I think. And the exam is just a minute, I'm a bit lost on my papers. 631. This is this one. It is July 2020. So if you go to the other set of slides, July 2020, part 6. So let's go together before coming back to slide number 27. Okay, let's go to, what was it? Yeah, lost. Yeah, that's it. So I'm here. I'm on the 20. It is part 6. Part 6 it is here. Okay. So let's be sure that I share. Okay, so I hope you see the screen. You have a screen. You get the second part of the exam for 2020, July 2020. So it is July 2020 exam, part 6. It is the last the last part of the exam, question 1. That's where I am. So I hope you see this. I try it again. I think I'm correct now. So we should be in line together. At the bottom of the screen here, you see part 6, cost of equity, dividends, leverage, 20 minutes, 4 points. Right? So let's have a look to the question here. And after that, we go back to a calculation and the explanations. The equity and liability side of the balance sheet of Julia Company is 10,000 euros, long-term debt 6,000 euros, with an average cost of 7% before taxes. We get medium-term debt 3,000 euros, average cost is 5% before taxes, and short-term debt 1,000 euros, average cost is 2% before taxes. Okay. The financial manager asks you to calculate the average cost of debt before and after taxes when the firm is profitable and when the firm is non-profitable. And the tax rate here is supposed to be 30%. So that's the first question. We need the weighted average costs, of debts before and after taxes for a profitable and non-profitable firm, and we have good information on the tax rate, 30%. If you are back into the first lines here, you understand that probably we have several long-term debts. It is an average cost, 7%. We have several medium-term debts. We have also several short-term debts. And each time it is an average cost which has been already calculated. So we are working with average cost for each category of debts. Okay. You understand also that the average cost for long-term debt, 7%, is higher than the average cost for medium-term debt is higher than the short-term cost, 2%. That means we are in a situation. We are in a situation with a traditional interest rate curve. The interest rate being increasing with the maturity of the loans. Very traditional. That's what you find in the textbooks. And this is what you find generally on the stock market. And we show you some graph next time. So this is what we are looking for. And my proposal is to go through this question before going further. And to go through this question, we have to go back, to the 93 slides. That's it. And I'm here with slide number 27, for the set of slides, which is called by PowerPoint, 93. And you find here the title, which is WACC, weighted average cost of capital, P and taxes. This is the topic. Cost of debt before taxes first. Okay. So if you follow what we have read together, part 1, it's easy to go through. Point 1, we have long-term debt cost 6,000 multiplied by 6%, 6,000. There's a mistake somewhere. No, it's not wrong. I am wrong. I'm sorry. What's happened there? 653, 1,000, 4,000. There's a mistake somewhere. I don't know why. I've moved the data. I don't know why. I'm very sorry for that. Anyway, let's use the calculations here, and you will be able to find the right calculations using the exercises at the time. Bond. If a long-term debt is 6,000, and instead of what you find here, the average cost is not 7%, but 6%, that means that the interest paid every year on 6,000, it's 6% multiplied by 6,000, which is 300. If you do the same calculation for the 3,000 medium term, 5%, okay, you get 150. And if you do the same calculation again for the short-term debt, you get 1,000 multiplied by the average cost, which is 3% here in my slide. And you get 30. That means that with this data, the cost for the long-term debt is 300, the cost for the medium-term debt is 150, the cost for the short-term debt is 30. If you add all these elements of costs, 300, 150, and 30, you get 480, which is 1.4. Okay. You can come back and the exercise and make the calculation with 7% instead of 6 for the long-term debt, with 2% instead of 3 for the short-term debt. You find something which is very close to 480, but no, not 480. And of course, you divide now this total cost by the total amount of financial debt to integrate in the calculation. And you understand that here we are in a calculation of cost, not in a problem of financial structure, not the problem of leverage analysis. And you take into account all the financial debts, whatever they are, in the calculation. It means the long-term debt, 6,000, the medium-term debt, 3,000, the short-term debt, 1,000, total 10,000. And if you divide the 480 by 10,000, it's not very complicated, you find an average cost, which is 4.8%. So point 5, something which is just, a comment here. The average costs of debt, which is a weighted average cost, in fact, it is weighted, weights are the amount of each category of debt. The weighted average cost of debt is always between the extreme costs. You have here the most costly one, which is the long term, 6%. The less costly one, the short term, which is 3%. Okay, and you find 4.8, which is somewhere between the higher and the lower costs of the different categories of debt. This comment will be applied also later to the weighted average cost of capital, which is always somewhere between extremes, which are the average cost of debt, here it will be 4.8, and the cost of equity. And this can be explained also, all these elements can be explained by a financial theory. This is point 6 you find here. According to a financial theory, empirical analysis, when you see that in normal markets, financial markets with normal arbitrage, you always have long-term interest rates higher than medium-term short-term interest rates. Okay, and you also always have average cost of equity. There's all equity is always higher than the average cost of debt because of risk level, which is much higher on equity and on debt, whatever are the debts. And of course, when you have weighted calculations, practical experience show that the WACC is always somewhere between the average cost of equity and the average cost of the financial debts. That's what you find on that slide. Okay. Now let's move to the next slide, which is slide 28. Yeah. And this is a slide where we explain what's happened for profitable and unprofitable companies. When a company is non-profitable, which is point 2 here, there is no change for the cost of debts before and after taxes. They are the same. It means you don't pay any tax on negative net income, net earnings. So there is no impact, no influence. For profitable companies, the cost of debts before taxes is higher than the cost of debt after taxes, because the cost of debt, interest, can be deducted, into the income statement. And you find the formula here, 9.4 T2. It means the result after tax is equal to the cost of debt before taxes multiplied by 1 minus the tax rate, which is a basic formula you have already met. So that means that in that case, 0.5, cost of debts is equal to the 4.8 we have already calculated, multiplied by 1 minus the tax rate, which is 0.25, which means it is equal to 4.8% multiplied by 0.75, which is equal to 3.6%. Well, what you find, of course, is that the cost of debt after taxes, 3.6, is lower than the cost of debt before taxes. Is lower than before. The cost of debt is the same for non-profitable companies because you don't pay taxes. It is different for profitable companies. A question is, what is the cost of debt which is to be used to calculate the WACC and the return on investment? And if you remember what you did with Olivier Brozard, this is very clear. You use the cost of debt after taxes to calculate the weighted average cost of capital and the returns of investment. It means a formula like the net present value, internal rate of return, or even the profitability index, right? Because you just divide the NPV by the level of total investments. So you understand it is very important to calculate precisely the cost of debt after taxes, the average cost of debt after taxes. 29 now, it's another question. It's about leasing, and we have a calculation here with leasing and with taxes. Sorry, I'm so. Yeah, that was here. Okay, 28. So the question here, which is introduced in the calculation, and if you have a look again to your to a question of your exercise part 6, it is the introduction of leasing. The financial manager in signs the leasing contract for the debt equivalent here of 5,000. It is 4,000 in the exercise. It doesn't matter. And this contract, it is a cost before tax, which is here 7% in my slide. And ask you to calculate the average cost of debts, including the leasing contract, when this contract is considered as an operational lease or financial lease. Okay. So my point here will be, what do we do? First, we have to analyze the leasing contract. What is in really? Leasing a debt contract, which is very similar to, is it a leasing contract, which is very similar to a debt contract, just with a specificity, which is this ownership guarantee, and the fact you set is financed 100% by the contract instead of generally finance 70 or 80% only. Or is it an operational contract? It means it's one way to present classical rent, but there is no branch of potential acquisition of the asset at the end or even before the end of the contract by the user. Okay, so this is really the first element to understand. We have two different cases, and in fact, operational leases are not taken into account in our calculations here. They are integrated for the level of the amount of rent paid every year in the income statement. We are interested in financial leasing contracts. It's not a problem of accounting presentation, it's a problem of financial analysis. After that, depending on the accounting system, you can have an accounting system which is in line with financial analysis, okay? But you can have a financial analysis which is different from the accounting presentation. That's two different things. Accounting is not finance, finance is not accounting. They are connected, but this is not the same field. We have different rules, we have different goals, we have different approaches, we have different regulations, okay? So here, the answer is very simple. If it is an operational lease, it doesn't have to be integrated into the calculation. If it is leasing a financial contract, it has to be. So we know the total costs of the debts before the leasing contract, and that's what we have calculated. This is a total of free of interest, 480. We have the cost of a leasing contract, 5,000 for the leasing contract, and the cost here is supposed to be 7%, which is 350. So total costs of the free debts plus the leasing contract before taxes, we have before taxes here, is 480 plus 350, which is 830. Okay, and the total cost here is equal to 830, what we have calculated, divided by the total amount of debt plus the amount of leasing contract, 10,000 plus 15,000, which is 553%. Okay, so that's how it can be integrated into the calculations. Okay, that's how it is calculated. That's where we are. Okay, so after that, we have to come back on the calculations, depending if the firm is profitable or not. And this is what has been done here for the calculation of cost of debt with leasing and after taxes. So we have 553% with the leasing contract but before taxes. And now if you make the calculations after taxes, it's 553 multiplied by 75%. 0.75 if a firm is profitable, of course, we have in that case, which is 415,450. So up to now, we have 4 different results. Last two are 415 leasing included after tax, 553 leasing included before tax, and remember we have 4.8 and 3.6 in the preceding calculation, only debts before tax and after tax. So that means, you know, if you take the extreme here, 3.6 and 553, you find data which are quite different. So you have to be very careful when you make the calculation. If you want to get something which is understandable first, and second, adequate to make calculations of the weighted average cost of capital, and after that of the NPV or element of cost of financial resources. So this is what I can do for today. You know, we will come back on the other calculations now, which are WACC calculations next time. And we start with number 31 and WACC calculations. You know, what I did today was really to cover, you know, a large amount of new elements, risk and maturity in debt contracts with different structure. First, hybrid products presentation, convertible bonds, leasing contracts, and preferred shares. Second, meaning, understanding, explanations, and calculations around the PE and the payout ratios. The simple model of valuation, also point 3. And we had here the beginning of the part 6 exercise with the calculation of the costs of debt before and after taxes, and the debate in the second part of the integration of leasing contracts with the case of financial option contracts with in a profitable and non-profitable firm, and make the calculation in each case, and we have this is our 4-digit for data here, okay, 4.8, 3.6, 553, and 415, and we understand that we have to be very cautious in the analysis of the profitability, of the nature of the leasing contracts, you know, in the average calculations of in the calculation of the average for each category of debt also, if you want to get data which are useful for the future of the analysis, the calculation of weighted average cost of capital, and some other elements of analysis. So this is what I wanted to show you today. You know, you have a few days before coming back for session 4. You know, what you can already do is to work on your assignment. I will send this. I already sent an email to this is actually Miss Tram. You will have to prepare, you know, a report on biotechnology. It's mainly, if you go back to the question, it's mainly question you didn't deal with up to now, without the last 2 questions. You know, because the last 2 questions are on valuation, and valuation is not what is really needed now. It will be for company valuation. So that means if you come back to the biotechnology case, you know, you are mainly interested here by question 3, question 4, which are the center of your analysis. It depends what you have already done on question 2, if you are clear on the cash flows, but after that it's 3 and 4, which is the center. Can introduce question 5, but the problem is not a problem of valuation here. Okay. So thank you very much, thank you very much, and I hope to see you very soon. Okay. Goodbye.
Thank you, Professor. See you on the 15th of
I see you
September.
on the 15th. Yeah, probably
Yes.
we have possibilities to exchange emails between. But anyway, I will not be in France next week.
Okay.
So, and I think it will be difficult to reach me. Perhaps if you leave a message on WhatsApp, it will be the easier way. I will be back on the 12th.
Yes.
Starting 12 in the evening, we'll be able to deal with my emails. Okay?
Okay, it's okay.
Thank you very much. Good night.
Goodbye, Professor.